The past 6 weeks have been busy ones in my own portfolio. In fact, of all the stocks you see here, I actually sold four of these stocks. So, which four stocks are they and why did I sell them? My name is Brian Stoffel. Over the next couple of minutes, we're going to talk about this. And I want to give a shout out to Fiscal.ai for sponsoring today's video. You're going to see a bunch from them in just a minute. So, let's dive right in. The first stock that I sold in the last 6 weeks was CrowdStrike, the cybersecurity company. Now, it's worth looking at my own history with this company. The shares that I sold, I actually purchased all the way back in September 2019 for about $68 a share. And I sold it in December of last year. That's within the last 6 weeks at about $475 per share. That's over a seven bagger and annualized, that's a 37% return. So obviously, this is a stock that I am super happy with. And I actually think that the company is doing very well. So why would I sell my shares? Well, to understand that, you've got to go back and look at how my portfolio's performed over the last 10 plus years. Now, as you can see, my returns are right here in the green with the S&P 500 in the red way down here, and then the NASDAQ composite in the yellow underneath mine right here. Now, one thing you might notice as you look over this is that 2022 was especially painful, and I'm trying to learn lessons from that episode. And one of those lessons that I learned is that valuation does matter. Now, I want to show you why I thought CrowdStrike at $475 per share was expensive. Now, I think that there are a lot of things going right with CrowdStrike. I want to be clear about that. And I would not be opposed to getting back in at a lower price or at a better price point as we find out more from earnings what's happening. So what I'm doing here is I'm heading over to Fiscal.ai and I'm going to show you some slides. Now, Fiscal.ai is one of the best tools we have found on the internet that you can use for free. Now, if you want full functionality, if you use the top link in the show notes below, you'll actually get 15% off an annual subscription. But what I want to show you here is that analysts really expect CrowdStrike's revenue growth to flatline, but to flatline at over 20% growth moving forward. Now, that number is really important, over 20%. That is a lot of growth, and that's going to be an important number to remember when we do a reverse discounted cash flow analysis. Here's the other nugget that we need to have before we do it. If we go to the company's investor relations on Fiscal.ai and we look at the slides that they create, now I'm flying by the seat of the pants here. They almost always include this. They tell us what they think that their ideal their margins are. And right here, you can see that they believe that their target operating model could have free cash flow margins as high as 38%. The way that I do my reverse discounted cash flow analysis is by solving for revenue. And I do that by optimizing the free cash flow. So right here, you can see that CrowdStrike has between 4.5 and $4.6 billion in free cash flow. If we take that number and we multiply it times a 38% free cash flow margin, what we basically get is $1,750 or $1.75 billion in optimized free cash flow. Using my reverse DCF calculator right here, I can put that in. And what I'm saying here is I'm giving a 3% terminal growth rate, which I think is fair. Some might say it's too conservative. A 10% discount rate, which says, what is the revenue growth rate that's needed to match the market here? And so what we already saw is that over the next couple of years, analysts are expecting about 20% growth. This solves over the next 10 years. And so right now it's trading at $440 per share, but I got out at about $475 per share. And what we can see is that what that was figuring was about 24% growth over 10 years. So look at this. We can see right here that revenue is expected to grow at about 22% over the next 3. But what the price at that, what the stock at that price was saying was analysts or investors are betting that the company will grow at 24% over the next 10 years. That's a longer time frame. That's a higher bar. So that is why I traded out of that. Now, I might actually be wrong about this. I might buy back into CrowdStrike at a higher price, but a better value point, because we might get some more information about revenue growth that surprises. And if that happens, I'll be happy to buy back in. But that's why I not only sold some CrowdStrike, but I actually sold out of it altogether, which is the same story when we look at the next stock that I sold, which is Shopify. Now, this is a company that I originally bought shares of way back in 2017 when it was between $4 and $5 split adjusted per share. Now, the shares that I actually sold, I bought as recently as just this past April, but still something I'm very happy with because I bought it in the middle of the Liberation Day tariff kind of fiasco at just $76 per share. And last month in January, I sold them for about $144 per share. That's an 89% return. So again, as with CrowdStrike, why did I sell Shopify? Not only sell it, but sold out of it entirely. Now, look, again, this is new for me. I think that Shopify is a very anti-fragile company. I think it has a wide moat. I still think it has quite a bit of optionality. And I consider it to be in my portfolio, but just with a 0% allocation. I will add back in when it seems justified to me. Well, with Shopify, we have a little bit of a more difficult time figuring out how to value it. And here's what I mean. If we look at the company's revenue growth rate, we see that it has been accelerating recently. Analysts expect that revenue growth rate to fall off into about a 24 to 23% range. They've been wrong by underestimating recently. It could be as high as 25% over the next 3 years. But the other part of this is we've got to figure out, well, what is an optimized free cash flow margin for Shopify? They have one type of revenue coming in, which is subscription solutions. That is very high margin, near 80%. But we've got another, merchant solutions, which is growing much faster, which is much lower margin. And so that can be a little bit difficult to blend those two together. If we look at free cash flow margins right now, we see that they've been trending up, especially after they got rid of their attempt at a fulfillment solution. I believe that they could get as high as 22, 23%. Let's split it in the middle. Let's say 22.5% free cash flow margins. Well, again, using Fiscal.ai, I can go and see that they've got $10.7 billion in sales over the last 12 months. So if I go 10.7 billion times 22.5%, that's $2.4 billion in free cash flow. So if they have an optimized $2.4 billion in free cash flow, well, then how fast do they need to grow to match that price when I sold of $144 per share? And the answer here is pretty fast. They need to grow 25, 26, about 26%. So think about it. They need to grow about 26%. Optimistically, it could be about 25% per year over the next 3 years, but we're talking about over the next 10. Again, I could be wrong about this, and if I am, I will happily buy back in at some point in the future when new information becomes available. But to me, we were getting towards the upper limit of what this company could squeeze out today, given what we know, and having a reasonable discount for those cash flows in the future. So that's why I sold CrowdStrike. That's why I sold Shopify. The third stock that I sold was Cloudflare. Okay, Cloudflare is a company that helps, it's a content delivery network that's branching into many other areas and could be a big winner. I think it will be a big winner moving forward. I just think that the valuation got really, really far ahead of itself. Let me show you a couple of key things, again, using Fiscal.ai. So I'm going to go right here to Cloudflare. And when I do, first thing I want to say is, well, what could their optimized free cash flow margins be at some point in the future? You can see right here, right now, they're at about 12% free cash flow margins. Well, if you go to investor relations, go to their most recent quarterly report, and we pull up the slides from that report, much like CrowdStrike does, management, if you go to the end of this, gives us an idea of what their model margins are. And right down here, you see free cash flow margins in their long-term model call for 25%-ish plus. So let's give them those 25% free cash flow margins. If we do that, we can go to financials and we can pull up the company's sales over the last 12 months. It's basically $2 billion, just a little bit more. Well, we know that 25% free cash flow margins off of $2 billion will be $500 million. So let's put in the ticker symbol, net, to $500 million in optimized free cash flow. And remember, if we go to Cloudflare, I bought these shares again, as I did with Shopify during the Liberation Day plunge that happened. And I got them at about $100 per share. I sold them for about 195, which is a great 95% return in less than a year. So I sold at about 195. If we look over here, what's the growth rate revenue needs to be for that 195? And this is where we're going to see it really climb. We're saying that Cloudflare had to grow at 33 to 34% per year for 10 years with 25% free cash flow margins to justify that stock price. Well, how fast is revenue expected to grow over the next couple of years? Well, again, if you pay for Fiscal.ai, you can see this. It's expected to grow at an impressive rate. It's expected to flatline at about 27%. Look, if they do that, that is something that is, most companies would give their right arm to have 27% growth rate flatlining. The company is very anti-fragile. But remember, I said the stock is priced in for about 34% growth. Now, that revenue growth rate could reaccelerate upwards more than we're expecting, and that will make my decision a poor one. That's entirely possible. But there's a huge difference between growing at 25 to 27% for 10 years. And by the way, this is just 3 years, not 10, and growing at 34% per year for a decade. And that is why I sold out completely of Cloudflare. Now, the fourth stock that I'm going to introduce you to is actually the stock that created the most returns for me in 2025. But before I get to that, I want to reiterate that I've been following my own portfolio for more than 10 years, and I have a program designed to teach other investors how I do this. Now, you might be wondering, where are you putting all this money? Well, the answer to that is something that I revealed to members of my program, Stock Investing Mentor. Now, if you join Stock Investing Mentor, you get 1 hour of live weekly training sessions where I give a nugget, and we have a session to teach that to people every week on Thursday at noon Eastern. Everything is recorded so you can see it. Importantly, you also have full access to my real life portfolio, which accounts for 90% of my family's real life net worth. There, you will find out exactly where all of this money is being reallocated to right now, along with full explanations for every move I make. And you also get 24/7 access to a private online investing community. Now, if you click the second link in the show notes below, you can use that link to get 10% off an annual membership to Stock Investing Mentor, but that deal will expire at midnight, 11:59 p.m. on Wednesday, February 4th. So, what is the stock, the last stock, the fourth one that I sold? And the answer to that is Rocket Lab. But it's important to note that unlike the other three stocks, I did not sell out of Rocket Lab entirely. Instead, this is a company that I purchased as a starter position and became what I call a booster position just back in February of 2025. And I bought a bunch of shares at $20 per share. Well, by last month, when I didn't sell out, trimmed the position, it had gone up 370% to $94 per share. And the fact of the matter was, it was one of my largest holdings. Now, I'm not going to tell you about the valuation of Rocket Lab because I actually don't think that this is the type of stock that you can value very easily. Instead, because the company's Neutron rocket launch, which is supposed to happen in the next couple of months, at the very least in 2026, could uncap tons of revenue growth for Rocket Lab going forward. It is basically in a duopoly with getting things into outer space with SpaceX. So the reason that I trimmed it was just because a company with such an uncertain future had become one of my largest positions. So I did not sell out of it entirely. I just pared it back to a more reasonable single-digit allocation within my own portfolio. So those are the four stocks that I sold from my own portfolio: Shopify, Cloudflare, Rocket Lab, and CrowdStrike. What do you think of these moves? Let me know in the comments section below. Don't forget to hit subscribe. And if you want to find out where I reallocated all that money, don't forget you've got the next 48 hours to register for Stock Investing Mentor with that 10% discount. We'll see you next time when I talk about these companies right here on this channel. Until then, Brian